The Monetary Authority of Singapore is the world's second largest buyer of gold in the first half of this year. That's according to a report by the World Gold Council. It shows MAS adding 73 tons of gold to their reserves from January till June this year, second only to China, which has been buying gold for 8 straight months. In fact, demand from central banks globally for the first 6 months this year hit its highest in 23 years, totaling 387 tons. But that's not the case elsewhere. In the technology sector, for instance, gold used in electronics products fell to its lowest, even below 2020 levels, when the pandemic had hit economies the hardest. Consumers as well buying less gold, with jewelry, gold bar and coin sales falling. Well, analysts say this reflects gold's waning popularity in the face of lower inflation. And for the rest of the year, analysts expect central banks to continue buying gold, especially those in developing economies. And that's also expected to lift investor demand.
And for more on this, we're joined by John Reade. He's Chief Market Strategist at the World Gold Council. He's speaking to us from London. Mr. Reade, very quickly, how does gold function to help diversify a nation's reserves or help maintain currency stability?
Well, it's very much like the case for an individual, actually. All the work that we've done shows that having gold in a portfolio improves the performance of that portfolio, and it does it in a couple of ways. First of all, it contributes to returns for the portfolio, but more importantly, it actually helps diversify the risks in that portfolio, lowering the overall volatility of the portfolio and preventing drawdowns. It can also be a source of liquidity as well, because gold's a very liquid market. Almost as liquid as the S&P 500 constituents, so $150 billion a day. So we're talking about an asset which performs well during crises, like during the COVID pandemic or during the global financial crisis, but has also been a source of returns over the long term as well. But crucially, it's not correlated to the performance of other assets in the portfolio and therefore offers genuine diversification. So we're seeing central banks buy more gold, but we're also seeing individuals and institutions buy gold as well, as they recognize that in these times, having gold in your portfolio is a sensible thing to do.
And Mr. Reade, it's not just Singapore, but other central banks are also snapping up gold. So is it just a natural hedge against inflation?
It fulfills a number of roles for central banks. I mean, it's probably its biggest attribute for a central bank is it's an alternative to existing reserve currencies. So if you think of the reserve currencies in the world that generally make up the foreign exchange reserves of central banks, typically the US dollar, followed by the euro. There'll be some yen in there, probably some sterling, maybe some of the smaller liquid currencies as well, like the Australian dollar or the Canadian dollar, perhaps the Swiss franc. And all of these are affected by inflation. They're all affected by monetary policy. Gold is an asset which doesn't fit into that matrix in the same way, and often gives you protection in a portfolio when currencies can be weakening. So it's an asset, I think, that almost all central banks have. Developed market central banks tend to have more. Emerging market central banks tend to have less. That's one of the reasons, for example, why China is such a big buyer, because it only has about 4% of its vast foreign exchange reserves held in gold. Singapore has been buying too, which I think is really reassuring. And as a very large holder of foreign exchange reserves, as I say, I think it's right that they should have a greater proportion of gold in their reserves than they used to have.
Mr. Reade, which brings us to the next question. For all the advantages of having gold in your portfolio, clearly, as you just hinted at, different countries have different levels of gold in proportion to their other assets at different stages of their economic development. Why is Singapore, at this point at least, on paper, the world's second largest buyer of gold between January to June of this year?
Well, I think there's clearly been a recognition from the Monetary Authority of Singapore that as a developed market, if you compare their holdings of gold at about 4% of their total reserves, that's quite a lot smaller than other developed market central banks. So I think that's one point, is to a certain extent, it's them recognizing that they're underweight gold compared to many of their peers. I think the second thing is central banks around the world seem to be recognizing that the world has changed quite a bit. And it's changed in principally, I would say, in the inflation outlook. We've had post-global financial crisis, central banks have struggled to get inflation high enough. They've struggled to get it up to 2%. Now, it's very much likely that that's not going to be the case going forward. And the challenge for central banks around the world is to get and keep inflation down at the 2% target. So if we're in a higher inflationary environment, that could be an environment where having more gold in your portfolio is advantageous. I think the second thing is, as well, is geopolitical risks may have risen. We've had 20 or 30 years of a post-Cold War dividend. That may be coming to an end. And I'm not just talking about Russia's invasion of Ukraine. There's other major tensions around, not least the trade tensions between the United States and China, and uncertainty about what the eventual outcome will be regarding Taiwan. So I think countries and their central banks are looking at the economic and political backdrop and seeing that it may be quite different from the way that it's been over the last decade or two.
We talked about, geopolitical uncertainty, and you've also mentioned about the importance of diversification. So besides gold, what other investments could be seen as a safe haven as well?
Well, certainly from a central bank perspective, it's tricky because the only thing that the International Monetary Fund recognizes as an alternative to currencies or government bonds, etc., is gold. So oil doesn't classify, nor do any of the other commodities. So when it comes down for a central bank looking for a safe haven outside of the existing reserve assets, then gold really is the only choice for them.
Oh, thanks so much for joining us. John Reade, Chief Market Strategist at the World Gold Council, speaking to us there from London.